The market's been open for 20 minutes. You followed your plan to the letter, trying to day trade a quick scalp, but the market is just chopping sideways. You get stopped out, then you reverse and you get stopped out again. You're already down 2%. You double check your setup. Yep, textbook entry, tight stop, clear target. So what gives? Why is your equity curve falling off a cliff like it's chasing a runaway train? Because the market is sitting at a major crossroads, and you, my friend, are trying to race down a street that's still under construction. It's like showing up to a chess tournament with a stopwatch. Technically, you're ready to compete, but you're playing the wrong game. Stick around because we're going to fix that glaring mismatch today. It's time to get your trading style in tune with the market's current location. Here's a stat that might just open your eyes. A whopping 73% of consistently profitable traders who actively switch their primary style to match the market structural position, meaning where it is relative to major support and resistance, saw their equity curve jump within a single month. Think about that for a second. What does that translate to? It means your meticulously crafted, perfectly back tested strategy might be absolutely brilliant. But if it doesn't rhyme with today's market location, it will shred your account anyway. It's not about having a bad strategy, it's about having the wrong strategy for the current market structure. Most losing trades aren't bad trades in themselves. They're often just the right trades executed in the wrong location. Imagine a jazz musician trying to play heavy metal. Technically skilled, but the vibe is all wrong. Day trading, for instance, truly thrives when the market is stretched, overbought or oversold, and far away from key price levels, creating the conditions for a sharp, fast snapback move. Consider what happens when a market is stretched 10% above or below its 200-day moving average, or over 3% above or below its 21-day moving average. It's like an elastic band pulled too tight. Day traders who specialize in mean reversion can come in looking for that quick, violent snapback toward the average. They aren't trying to call a major top or a major bottom. They're just playing the odds of a short term correction. Now, imagine trying to swing trade a long position at the top. You're buying at the point of maximum risk, just as the elastic band is about to snap back. Swing trading, on the other hand, absolutely loves it when the market pulls back to a major, well defined support or resistance zone, offering a high probability area to enter a position that can last for days or weeks. They're looking to buy for a multi day bounce. But what happens to the day trader here? They get chopped to pieces. The market hesitates, buyers and sellers fight for control, and you get dozens of false breakouts and breakdowns. Death by a thousand paper cuts for a scalper. Both camps simply ignored the clear, undeniable message of the market's location. They were playing a different song. So, the $1 million question is, how do you diagnose today's market location before you bleed another grand? All right, let's get down to the brass tacks. You need a quick, actionable routine. First off, pull up a daily chart of the S&P 500 and identify its location. Is it near major support or resistance level? We're talking about key moving averages like the 21-day, 50-day, or 200-day moving average, or significant previous highs and lows. If the price is consolidating at one of these critical zones, the market is preparing for a larger multi-day move. This environment screams favor swing trading. Why? Because you're positioning yourself at a pivotal point where a major trend could begin or reverse. Now, how do you know if the market is stretched? Simply measure the percentage distance from a key moving average like the 21-day. If the market is trading 3 to 5% away from its 21-day moving average, it's extended and likely to revert to the mean. This is where you favor day trading. The market is prone to sharp, fast corrections, offering plenty of quick, explosive moves for scalpers. You also need to scan the economic calendar. Major Fed days, CPI reports, or big earnings announcements can be the catalyst that either causes a breakout from a key level or triggers that sharp mean reversion. If you absolutely hate carrying a swing position through a 2 p.m. presser, admit it, adjust your plan, and maybe sit on your hands until the dust settles. Knowing these events beforehand is half the battle. Do this routine every weekend. It takes just a few minutes and it could save you four figures or even more in avoidable losses. Now let's get practical, shall we? This isn't about what you want to be, it's about the market and your personal circumstances allow you to be. Answer these questions with a simple yes or no. Number one, can you genuinely sit in front of your screen for the first and last 90 minutes of the trading session without interruption? We're talking focused, eagle eyed attention, not checking emails or making coffee. Day trading demands this kind of presence. Number two, does your account comfortably absorb 5 to 10 round trip trades every day without breaching the dreaded 25,000 pattern day trader cushion? Or are you trading from a cash account? If not, frequent day trading is a no go in the US market, and attempting it will only lead to frustration and account restrictions. And finally, ask yourself, do you emotionally rebound from 3 consecutive full stop losses within an hour? Day trading is brutal, fast-paced game. You will hit losing streaks. If that sends you spiraling, it's going to be a tough road. If you scored 3 resounding yeses, then congratulations. Day trading is definitely open to you. Your temperament and situation aligns. Now let's flip the coin for swing trading. Ask yourself, is your day job or other commitments perfectly okay with you checking charts only at lunch and after hours? Swing trading allows for this flexibility, requiring less constant screen time. Ask yourself, can you handle waking up to a 4% gap against your position without panicking? Swing trading inherently carries overnight and weekend risk. News can break while you sleep, and the market doesn't care about your beauty rest. And lastly, ask yourself, do you genuinely prefer fewer but potentially bigger winners, even if it means enduring weeks of drawdown before a significant payout? Swing trading requires patience and the ability to ride out market noise for larger moves. Three yeses here swing the door wide open for swing trading. Most people, let's be honest, will find themselves mixing answers. And that, my friends, is exactly where the hybrid approach comes in. This is what I use. It offers the best of both worlds. It's about finding your unique fit, not forcing yourself into a tight box. You don't have to marry one style for life. Think of your trading account not as a single vehicle, but as a multi speed transmission. Allocate about 80% of your capital to the regimen that perfectly matches today's market location, and keep a smaller 20% slice for experimentation. Let's say the S&P 500 has pulled back and is now testing its 21-day moving average. This is prime swing trading territory. Run your swing positions with a risk per trade amount or allocation amount that you are comfortable with losing both emotionally and that your account can afford to lose. We're aiming for a multi-day bounce off that key support. With your experimental 20%, you can day trade any sharp pops or drops, staying sharp and learning the intraday dynamics without risking serious capital. You're building skills for when the market shifts. Now, what happens when the market gets wildly stretched? You flip. 80% of your capital now goes into intraday short scalps looking for mean reversion, but with that same risk per trade. Because these moves can be fast and violent, you need to honor your stops and your plan with discipline. Your 20% slice, that's where you might want to take a few swing trades on names that are sitting at support or resistance. Crucially, track each sleeve of your strategy in separate columns of your trading journal and review them weekly. This disciplined approach keeps your skills fresh across different market conditions, keeps your psyche sane by managing expectations, and most importantly, keeps those drawdowns capped. I've personally used this toggle system for the last 2 years, and my max intra month drawdown dropped from a heart stopping 11% to a much more manageable 4%, all while my monthly return stayed roughly the same. This isn't about being a master of one style, it's about being a master of the market timing for your style. Style timing beats stock timing every single time. This all sounds deceptively easy, doesn't it? Just switch gears, but try it. Your brain, that stubborn organ, clings to identity like a limpet to a rock. You hear phrases like, I'm a day trader, that's who I am. Or, I swing, I don't stare at charts all day, that's just not me. Guess what? The markets don't care about your identity. They care about order flow, about supply and demand, about whether price is at a level that attracts buyers or sellers. Your ego, your self imposed label, is a liability here. Price is king. The fastest, most effective way to override that pesky ego is to pre write an if then statement directly into your trading journal. Make it an unshakable rule. Something like, if the ES closes within 1% of its 21-day moving average for 2 straight days, I will flip my primary style to swing trading within the day. Then, when that condition triggers, you obey it like a robot. Robots don't get emotional about labels, they just execute the programmed commands. Or what if the if then reads like this? If ES is 3 to 4% away from its 21-day moving average, then my focus is day trades. Within 3 or 4 of these flips, you'll notice that the internal identity noise starts to quiet down. Your results, consistent and improved, will do all the talking you need. It's a powerful psychological hack that transforms emotional trading into systematic execution. Now, a word of caution. The temptation to flip flop every time the market touches a moving average can be strong. Resist it. Over toggling will drown you in commissions and whipsaw your mental capital faster than you can say bid ask spread. Use a 2 day confirmation filter for your style changes. Don't react to a single day's touch of a key level. And critically, cap yourself to one style change per week maximum. This prevents emotional knee jerk reactions. Also, a vital point, keep your risk per trade static in dollar terms, regardless of the style. Switching styles is absolutely not an excuse to triple your position size because you're suddenly so sure this new style is your golden ticket. That's a fast track to blowing up your account. Finally, this is super important for learning. Log every single toggle reason in one concise sentence in your journal such as ES stretched 8% from the 21-day moving average. I'm favoring day trades. Or ES is testing support or resistance. I'm switching to swing trades. After 10 or 20 flips, you will have built a personal playbook, a roadmap for future you that will be invaluable. You'll thank yourself for that discipline. So let's be clear. Your strategy isn't broken. It's not ineffective. Its location is just off. The market is a living, breathing entity, constantly moving between being stretched and coiling at key value areas. Your job as a trader isn't to force it into submission, but to adapt. Run that quick 4-minute vitals check every weekend. Answer the day versus swing questionnaire honestly, truly knowing yourself and your limits. And crucially, pre commit to an if then toggle rule, writing it down and obeying it without questions. Markets evolve, and now your trading style can finally evolve right alongside them. No more of that soul crushing frustration of following a perfect plan yet still losing money. Hey, if you've ever followed your rules perfectly and still took a frustrating loss because the market just wasn't cooperating, smash that like button. Let's see how many of us are honest enough to admit it. And hit the subscribe button so you never miss a video aimed at helping you become a more consistent and disciplined trader. If you're looking for a place to trade live with me every day, I invite you to join me in the trendy room at Simpler Trading. There will be a link in the description. Have a great day.